Welcome to our Vodcast, presented by Jasmine Brown, Emma Jeeves, Jamie McDonald, and Matthew Mackenzie. The aim of this Vodcast is to investigate and analyse net present value as a method of capital investment appraisal. This will include an event-related example, definitions, and a comparison between net present value and payback. Information has been acquired from the internet and relevant accounting books.
What is capital investment appraisal? Capital investment appraisal, also known as capital budgeting, is primarily a planning process which facilitates the determination of the concerned firm's investments, both long-term and short-term. So in theory, the purpose of capital investment appraisal is to help managers make a decision on whether a proposed long-term project is worth the funding of cash. Although there are 10, the four main methods used to calculate capital investment appraisal are accounting rate of return, net present value, payback, and internal rate of return. Net present value and the internal rate of return are both discounting methods.
In this podcast, we will focus on payback and net present value. In terms of the accounting rate of return, this focuses on profitability rather than cash flows. It is calculated by taking the average profit earned per year divided by the average investment and is expressed as a percentage.
Internal rate of return is the interest rate at which the net present value of all cash flows from a project or investment equals zero.
Okay, what is net present value? The net present value method of investment appraisal looks at the net cash flows generated by an investment, which are then compared with cash outflows received in carrying out the investment. Each cash inflow is multiplied by the relevant discount factors for that specific cost and of capital for that specific year. The net present value of an investment project will be calculated by the net total of the present values associated with the project. Usually the net cash flows that arise from the project will be positive, and as long as the present values of the project outweighs the cost, it can be viewed as the project's potential investment. The advantages of net present value is the fact that it uses net cash flows to emphasise the importance of liquidity. Time value of money is taken into consideration, and the project's profitability and the return on original investment. The disadvantages of net present value is that it can be difficult to estimate the net cash flows accurately for each year of the project's life. It is also not easy to select an appropriate rate of interest, and it is a longer method to use compared to payback.
We have provided an example of the use of net present value and have portrayed it within the event industry. V-Festival are considering moving to a new location as they have found that their current location is inadequate for their future plans. There are two options available. The first option would be in Southampton, where they have a slightly larger area costing £12 million, although they could possibly move to Manchester, which will be twice the size of their current area they have in Chelmsford, costing £25 million. A larger area would give V-Festival a greater inflow of cash, as more festival goers would be able to attend. The relevant cash flows for both projects are as follows. And as you can see in the table that we have given you, it starts as the cost of area for Southampton is 12 million and the cost of the area of Manchester is 25 million. And from the first year to the fifth year, it shows the cash inflows of how much money they'll be making from the festival goers. And as you can see, the Southampton one won't be making as much as the Manchester one from the first year to the fifth year. The solution to our example. The cost of capital for this project would be 10%. All the cash flows are assumed to be receivable at the end of each year. The net present value calculations for each project appears as follows below. And as you can see, I had to put the Southampton section and the Manchester section in this table. So the cash flows decreases from first year to fifth year, and with the discount factor added on, that makes the present value for each location, and I've done that for Southampton and Manchester. So it totals the present values at the very end of year 5, and for Southampton it was 12,089,000, and for Manchester it was 25,420,000. You minus the cost of the location, which was 12 million for Southampton, and Manchester's was 25 million, and that gives you the net present value. And for Southampton it was 89,000, and for Manchester it was 420,000. Based on our calculations, the festival should choose the Manchester location, as it has a net present value of £420,000. Compared with the Southampton location, their net present value was £89,000, and showing that Manchester is the most suitable because having the higher net present value would be more of a profitable outcome for the festival.
Unlike net present value, the payback period method ignores the time value of money and is considered a non-discounting method, thus not taking into account any interest rates. Time value of money is the concept that cash received at an earlier date is worth more than a similar amount of cash received later. Net present value also acknowledges all of the cash flows for each investment opportunity after the amount has been paid back, whereas the payback period only takes into consideration the cash flows up to that point. Both methods are effective ways for a business to calculate the return on an investment. A firm may want to use the payback method as a more simplistic method if they are a business with insufficient capital to sustain long-term objectives. The NPV method may work better for a business that want to estimate the amount and timing of future cash flow. Many businesses will combine the two methods by using payback first to narrow down the options, then applying net present value to analyse the profitability.
To conclude, net present value is an effective and widely used method of capital investment appraisal that's considered to be the best way to analyse, evaluate and make a decision on the investment project. Thank you for watching.